the 2 pillars of risk management. It sounds really big, but here's what it is. I'm going to teach you about stops and position sizing, and those are both really, really important, which is why I call them the 2 pillars of risk management. I want you to think about this. When it comes to position sizing, I'll tell you this, one of the most costly mistakes that traders make, and sometimes they never figure it out, one of the most costly mistakes that traders make is they don't know what position size to take. They don't have any consistency at all in their trading. You know, if you buy the stock right, and this is a common frustration, if you buy a stock right and it moves in your favor and you get a, oh my gosh, this is a great trade, then you look at your account balance and you go, well, this barely even made a dent in my account because the position was too small. Of course, then you know what happens. On the next trade, you take a small loss and it makes a huge dent in your account because your position size was too big. The bottom line is this: you have to have some kind of methodology for selecting a position size, or your batting average really isn't going to matter. I mean, think about this. Let's say you bat 600, meaning every 10 at bats, you're going to get 6 hits. Okay, that's great. You know, you're in the Hall of Fame. But the idea of trading, as with baseball, is not to get hits. The idea of trading is to get the runners around the bases and score runs. And so the point is, if you've got a really, really good batting average, but you're not scoring, you're not getting players around the bases, it's really not going to matter. You can have a 400 batting average. You lose on 6 out of 10 trades. And if you're positioned properly, you can get rich only making 4 out of 10 winning trades. That's just the way it is, and that's a function of math. So here's the thing. When you think about position sizing, think about Goldilocks, okay? One bowl of porridge is too hot, then the next is too cold, and then finally it's just the right one for her. Now, we're not going to talk about what happened when the Bears came home. But the bottom line is on this: you need to have that one position size that works for you, and it's based on your portfolio and it's based on your plan for the stock. You know, Sun Tzu said every battle is lost, or I think he said won, but then the other side is the loss. Every battle is lost before it's even fought. Every battle is won before it's even fought. You know who basically wins? Is the one that goes into battle with a plan and some protection. And that takes me to the second pillar, which is stops. Okay, how tight do you set them? How loose do you set them? I got to tell you, one of the things that I never really took big losses because, frankly, when I first started trading, I never had very much money, so I couldn't afford to take big losses. But what I was doing was I was setting my stops too tight. I was getting jigged out all the time just on the basic up and down movement of stocks. There's nothing wrong with the stock. I just set my stop unreasonably tight and then just crossed my fingers and hoped the stock wasn't going to do what it ultimately did, which is wiggle and jiggle a little bit. So it's really important to have a methodology for stops, and I'm going to help you calculate that. I'm going to show you how to set your stops. It's a function of math, not magic. You don't just sit there and go, well, I got a hunch I'm going to buy a bunch, or, well, I don't really know, so I'm going to dip a toe. It's really important that you have a handle on how much stock, or options for that matter, how much you're going to buy. And then also, what are you willing to risk? There is a methodology to it. Have you ever seen a blackjack player? They're always amateurs. Go up to the $5 table with about $200 and then just start betting $5 here, $20 there. Oh, it depends on what the dealer has and this and that, or what I feel like is going to happen. They're just all over the place. And so what we need to do is we need to narrow down. We need to get rid of as many variables as possible. And I'll leave you with this because I know I'm going to see you at this course. I'm telling you. Back in the book of Matthew, where he wrote this long before I was ever born, talked about the talents. It's a parable of talents, where a servant, a king, rich dude, whatever, took 3 servants and he gave 5 talents to the one servant, 2 talents to the next, and then 1 talent to the last one. And it was all according to talent, literally talent. So the one that was the most talented got the most. You probably know the story. They came back, the guy with 5, hey, he had 10. The guy with 2, he had 4. They traded them into bigger position sizes. What did the guy with 1 talent do? He came back with 1 because he buried it. He stayed in cash. What did the king do? King took the talent from the one dude that was in cash and gave it to the guy that had 10. You be the guy with 10. Don't be the guy with 1, because you know what rhymes with 1? None. We're not going to go there. I want you to come and learn about the 2 pillars of risk management, and I promise you this, if you do what I tell you, there will be no way that you cannot improve your trading. I'll see you there.